fantastic to have you here in the morning. Let's please keep it informal. Ask questions whenever you would like to. I'm a little bit out of practice. I haven't done this for some years. And I think the last 8 years, my mouthpiece, Gary Watkins, normally handles the presentation. So bear with me. But it is certainly a topic that I'm incredibly passionate about. I always say I feel like a little man hunchback ringing a bell at the bottom of the garden when it comes to retirement and retirement savings. I think it is the most under-spoken about and the most under-addressed area in financial planning. And very, very, very few people retire at all, and let alone retire well. So we're just going to kick around a couple of ideas, a couple of perspectives, give you a little bit of insight into how we run our money. And then Mark is going to run us through the philosophy that we have behind our in-house fund, our 4 own unit trust funds. So I think I don't need to introduce myself. Everybody knows who I am. I'm the joint CEO of the group. I've been in the business for about 27 years. So learned from the School of Hard Knocks. I've owned a hell of a lot of businesses. And again, one of my passions is business. So we help businesses, we speak to businesses literally day in and day out. We do a lot of mediation, we do a lot of settlement between partners, we do a lot of input. And we basically created a business hub for entrepreneurs. If you have to say who is our target market is very definitely entrepreneurial people. We work well with them, and that is where our skill set sits. And when we first started this business, the intention was always to be able to be a resource to people like that. Because if you think about going into business nowadays or being in business nowadays, who do you lean on for support? Who do you ask for advice? 9 times out of 10, it's a bank manager who, my goodness, has never owned a business in his life. You wouldn't know a business decision if it jumped up and bit it. The same thing with an attorney, the same thing with an accountant. So in terms of resourcing your requirements, there is no resource in this country that enables entrepreneurs the way we do. And I'll run through a little bit of how we put ourselves together just to clarify that. So, ladies and gents, this is the group of companies that is represented here today. There are 10 of them. And as I said earlier, the intention of the group is to offer an end-to-end financial solution. It's not a case of a sales-driven machine selling policies like the old days, the old backslapping, stick-talking salesmen that would come and sell an insurance policy. We are not that. We're an advice house. We are financial strategists that actually make sure that what needs to be done is done. And I say probably one of our biggest value propositions is doing what is needing to be done, not what we're paid to do. And I think the biggest failing in our industry is most professionals only do what they're paid. And if I say that, if you task me to get you a shareholder agreement as an attorney, I'll draft the agreement and I'll give it to you. That's where my duty ends. But then shareholders agreement unsigned is not worth the paper it's written. So for us, it's not a case of just doing the shareholder agreement. It's doing the shareholders agreement, making sure it doesn't conflict with the MRR, making sure that it's signed by all parties correctly, making sure that every single process is followed. And the biggest flaw within our industry is that professionals are arrogant, really, really arrogant. So you find that your attorney will never ever back your account. And for goodness sake, the accountant won't speak to your insurance job, because that's like the last thing they do. And they're all protecting the little part. They don't want anyone fiddling in their part, and they don't want anybody to criticize them. But here's the rub. If your professionals are not speaking to each other, you've got a collision waiting here. Because this is a domino effect. You push one domino, and if the next domino is not in line, it doesn't fall up. So if we haven't got our ducks in a row across all of the disciplines, then we're going to be in trouble. So this is where we fit in. I'm not going to go into depth into each company, but to say that if we lose you as a client, we'll lose you potentially 10 times. So in terms of the value, we're putting money where your mouth is statement, is when we started this business, the intention was always is to own every business that gave us it, not to use third-party service providers. So when I say the buck stops here, I mean it. There is the ability for you to contact one person that has the ability to influence 10 companies outcome. So if you have a problem with one of the companies, we're going to look at you as a client and make sure that you're taking care of it. So in terms of a value proposition or a value statement, that's what we are. We really do. We don't say that we're going to say yes to everything all the time, but we certainly going to put you at the front of the queue all the time and in the front of our minds. So why would you be dealing with us? Obviously, you're dealing with a group of people. I think we're well over 100 people under this roof at the moment. And we have built over the last 18 years now a significant skill set. A skill set that is second to none in the country. There's nobody in the country that can rival the skills that sit under this roof. It's not textbook learning. It's actually learned by experience. Always say I'll pay private school fees. I haven't paid school fees. I've paid that and varsity fees. So, and we've done that with our clients for the last 18 years. So the exposure that we've had in terms of where we play is ginormous. There's nobody else doing what we do at the scale that we do, and nobody else with the capabilities. So we always say, where do we fit in? We fit in amongst your profession. We're part of your professional team. If your professional team will not speak to us, get rid of them, because they're arrogant and they're hiding something. If you've got a lawyer, we'll work with them. We don't want to replace it, but we want to work with them. If you've got accountants that you trust, fantastic, we'll work with them. But if they don't work with us, kick them out, and we'll put in our own people. So we can offer every single service to you, but we don't necessarily want you to have every single service. It's almost a boutique offering where you select what you would like to engage with, and you say, best outcome for me will be that. And certainly the best outcome for you is when the professionals are talking, and everybody knows what each one is doing in the program. So it's imperative to get that right. And the specialists within each area, guys, they are proper specialists in that space. We will not talk to a space that we're not comfortable talking at boardroom level. We will just not go there. But the ability when we do go there is at the highest possible capacity. We are really, really, I mean, it sounds terribly arrogant, but we are very, very good at what we do. And we do it across the board. So that's a little bit about why. And then on to today's discussion. Like I said, we're discussing retirement and investment today. Just going through what we are trying to achieve with the session today is why we need to plan. How do we start? What product? When should we start? A biggie for me is the effects of inflation. And then also understanding this investment world a little bit and trying to dumb it down into just casual talk and casual banter. I'm not going to show you graphs and figures and bamboozle you with spreadsheets. It's not going to be anything like that. It's just really a conceptual session to figure a couple of things out. So in terms of our advice philosophy, in the video we said there is no such thing as one size fits all. So our biggest challenge is to make sure that when we do a plan or a strategy for you, that you take ownership of it. It's not my plan, it's your plan. Structured around your requirements, around your needs, around your wants, around your plan for your life. So as soon as you start taking ownership of it, then our relationship gets to a level that's fantastic. If you see me driving to your driveway and that comes back again, you're going to sell me a product. Okay, then our relationship is badly wrong. I want you to say, hey, Brett, what are we doing next? You know, so the ownership of the plan has got to rest with you deeply. We obviously heavily client-ful mentality. We not hit you on the head and run up on the hills. We want you forever. So we engage with you personally. And if you engage with the group, you obviously form multiple relationships through the group. So you have a personal experience. There's one thing I hate, I don't know if I'm joined by anybody, is your call is important. Each hole, select one, select 3 for claims. Right? So we're not that company. We don't operate full centers, we steer that other way from it. We are strategists. So it's not a case about giving you a bespoke or giving you a vanilla solution. Do this, do this, do this, do this. It's a case of what is the strategy to get us where we want to go. And that's, if you think about it, a life plan. Who's got a life plan in them? Who knows exactly what their life is going to look like in 5 years' time? Who's ever given mind time to the fact that let's think about it, you know, and let's strategize. What are you working for? Why are you working? Once they say, let's pay the bills. Ooh, that's a terrible way to look at your life because you're spending your life paying everybody else's bills. When I sit with people and say, all right, draw up the budget. What comes first? Bond payment. Second, car HP. Third, groceries. Fourth, school fees. So, where's your money? What do you mean, my money? Where's your money? Why do you work? I can't afford to spend money. I've got to pay bills. Well, then we need to change strategy. We need to sit back and take a real deep look and say, we need to change something. Because my life starts with my money, okay, that I earn money, then my savings money, okay, and then we might start with bills. But if there's nothing in this game for me, I'm not going to play. Why do you all work? Answer a question. Okay, ultimately.
Also not that text that was coming out was a lot of successful. 86 and still doing it. It's like a teenage now and people come to the reference of the language when I so I just pulled it over and went, oh, that's 83. It's like 86. I mean, I don't think I want to be doing this kind of work at 86. Associates, I mean, 60 years the kind of work. So as you enjoy that, I don't know.
Well, I think most of the answers would be to retire one day. You know, that is probably why we put in so many hard yards. But here's the funny thing, is do you know how much money you're going to need to retire? And then let me put it to you in a different way. If you don't know where you're going, is there a fair chance that you won't get it? So the problem that we've got is we all have this idea, but no plan. Absolutely zero plan. Problem in this country is when I graduate or when I get my first job, I'll buy the most fancy car that I can afford. I'll buy the biggest house that my bond will allow. And I hope that by 65, I retire with I have paid for home and paid for car. What a sick world. What a sick world. So we've got to invert that process. We've got to say, listen, let's stop. Let's give retirement the airtime that it needs. So I want to come with a couple of sobering thoughts. And I just want to fire around the room. Some people will have gone through this process before. If you gave me R1 million, okay, what would you expect as a monthly return? If you said, Brett, give me a return of X amount for my life, you can have my R1 million. What would you expect? Fire off, you know, 10%.
6,000.
You can have it for 10 months. Right, 10% is what most people would think 10 grand a month. Huh? So let's invert this process and say, okay, cool. Bearing in mind, we're talking about retirement funds here. So we're not talking about high risk taking ability. If we put money into the bank today, for it to have the same buying power next year, we need to have inflation backed. What's inflation? Not in Hillcrest Kloof. It's more like 12 or 14. But anyway, let's take a 5-year rolling average. We are sitting unusually low at the moment, but call it for fun 7%. Talk about 1% for the jockey that runs your money. That's 8%. And then you want a 10% draw. That means I've got to do 18% compound return for you on your money invested. Is that possible? Okay. But yes, you are confident beyond confidence. You should be on our investment team. We've done it. We have done it. I'm not saying that it's impossible to do, but I'm saying if we are conservative, it's possible. So what you're asking me to do is quadruple the interest rate return from the bank. And that becomes impossible to do without taking the wild risk. And for me, in retirement, my money mustn't keep me awake at night. If I for one moment worry about my money or wrong. So perspective, guys, I would say 12% is a relatively acceptable degree, which leaves you 4% to draw per annum. So use this as your first yardstick in all of the rest of your life, is you can draw a sustainable inflation-linked income of 3,750 Rand per month, finishing cost. You can't do more than that. If you're doing more than that, you're going to affect the term that you might lose. And we'll get into a bit of that. So that's the first thing. I've alluded to knowing what you need to do to retire well. I've had people, often to the plan to say, I'm earning 150 grand at the moment, and when I retire, I need 50. So how does that work? Are you burning through 100 grand a month? No. Well, how can you go from 150,000 rand to 50? Yeah, but I'll be retired. Well, hold on. We'll get through the next couple of slides. Retirement doesn't mean that you expense. It maybe means that you haven't got a bond. I'll tell you a little funny story about this before the slide comes up. We had a client who retired. He retired college. And he eventually had to draw more money. So I said to him, what are you doing? Why do you need so much money? So he said, well, I've got to get out of the house. So wow. He said, Brett, I used to come home 6:30, spend some time with the wife, watch a bit of TV, go to bed. He says, I'm with her all day. And I figured out I don't like her. So, I'm playing golf all day. So in terms of having the money to be able to enjoy yourself, you're going to have time on your hands. You need money. You're going to want to travel. You're going to want to do things. It's pointless saying that you're going to cut your income. It's impractical. It doesn't work. So why do we need to play? And I've said it before, we might be debt free. Hopefully. A lot of people, again, don't even give mind to this. You say, align your bond term with your retirement. You know, how often do you take a 20-year bond, but then kids need school fees paid? Then kids need gas fees paid. Then kids need a car each. Then kids need this. So what we do, we kick it up, we kick it up. And then we get into a stage where Investec and R&D and all the fancy banks come to you and say, please, pull all of you there. We'll give you a facility. And you can just use it as and when you deem fit. You think, fantastic. Now all of a sudden my 5-year-old or my 5-year car that was going to amortize in 5 years is amortizing in 20 years. All of my short-term debt that was amortizing in 3 years is amortizing in 20 years. And what happens is I'm going to retire in 10 years' time. Okay, cool. When's your bond term? In 20 years' time. So make sure that you align these kinds of things. Understand that they will have an impact. What about travel and entertainment? You know, with the global citizenship currently on offer everywhere in the world, people have got kids everywhere. You know, and 9 times out of 10, their kids, 3-4 kids in 3-4 different countries. So that takes money. Go and visit. It's not a case of, listen, I can jump in my car and travel to the coast and go see my kids any longer. It's a case of you requiring serious money. If you're going to do that once a year, that's big money. We all aspire for the best in our day-to-day lives, like I say, driving CEs and driving BMWs, and the last thing on our mind is retirement savings. Because we're consuming so much of it that we haven't got any money left. So, and that, again, just a little thought process is most people spend and then say what's left. I want to invert it. I say save first and spend what's left. Because if you don't save, you're not giving yourself a chance at the time. You're sticking your head in the sand and you're going to that problem. And the big trick for me is to ring that alarm bell so loud now when you have time to change. You know, my dad retired when I joined this industry. And when I retired, he retired in 1997 with 850,000. So he said to me when he retired, he said, Brett, where were you 20 years ago? He said, I have been burning money for the last 20 years. I was of the opinion that I was sorted. I was on a pension fund. Okay, and in the old days, it was true. The pension fund was a defined benefit scheme that paid you a salary for life. But they did a fancy little footwork change in the late 80s, early 90s, where they said, we're not paying you for life anymore. We're going to give you a cash lump sum. So it went from income for life to a cash lump sum and destroyed his retirement. How many people in the room are, well, actually supporting both ways, supporting parents and supporting children? So for the first time in a generation, we're feeding both ways, okay? Because our parents never planned. Our kids, I mean, as old as they get, they move out of the house, they never move out of their bloody wallet. That's the problem. So,
My parents are now in their 80s. And I think one of the biggest benefits of all of those is add up the loss as well. If I have a look at us, the younger generation, you've had a discovery for all the years that you're healthy, and when you get to your older age and you're in trouble, you're going to find the money to supplement all of that. So there's so many principles that change your ground rules all the time. Capital gain tax. You prepared the retirement plan 20 years ago. It's unplanned.
correct. But that's an important factor of revisiting and keeping current. You know, that things change and are dynamic all the time. So you've got to be on top of it all the time. You've got to be nimble and capable of change. But very little. I mean, medical aid is a big topic for retirement, particularly post-retirement discussion, because medical inflation is outstripping CPI significantly. So when you start putting that into a post-retirement plan, You need to start really focusing on medical being one of your single biggest needs. Because every year that goes past, you hit a nail on the head. What happens is, hey, we're only giving you a 9% increase. Fantastic. What they're not telling you is your unlimited oncology now has come 300,000. What this has happened has come here. This sublimit has gone there. If you are unaware, as most of us are, I'm not suffering from cancer, I don't really give a damn. But get cancer, what's the most important thing in your life is whether you've got cancer covered. I had a very good mate of mine worked for me. He went through a bit of a rough time. He dropped from the old Liberty days from a platinum plan to a gold. And he dropped from unlimited oncology to an oncology limit of 120 grand. The month that he dropped, his son was diagnosed with leukemia. And he had to end up going to stay in Bloemfontein for treatment. It cost him his worth, literally under. So medical inflation is a huge topic, absolutely. Obviously, I need more medical and chronic medication costs for retirement. And the big thing is everybody's saying, listen, I don't really want to be a burden on my kids. Well, the good news is the kids don't want you to be a burden on them either. It's very definitely a problem that we face, and it's a real problem. Because 99% of the people retiring at the moment are not retiring well. And this whole thing of I'll sell my house, you know, you sell your house. You sell your beautiful 3-bedroom home in Town Hill that you brought your kids up, and you go and buy a funky little place in London Lane, and all it costs you is another 500,000 or 600,000 rand that you've got to put into the pot. So your home that you thought would be this wealth of money coming in retirement, actually it's barely.
We got kicked off Zoom.
Okay, no problem. I lost my train of thought. I've got a thumb in the air and I don't know. Everything's okay. So I have to have a plan. It's secure in a space that other people can't get afford. And that's retirement fund. It's protected from insolvency, protected from creditors. But the biggest protection, guys, is it's protected from your dirty little paws getting on that way. Because tell me in your life that you haven't been at a stage where you sell everything you've got for a great business idea, or that you're against the wall, you just need to pull all your money. In a retirement community, you cannot do that. And trust me, as a person who's gone upside down twice in their life, the only thing that I emerged with was my retirement community. So we put the money that we have to have. That means we're not eating cat food, we're not staying in a granny flat. We've actually got some dignity, we can afford a car. All of that goes to retirement fund. Then, once we've secured that, we can start with the flashy stuff. We can say property portfolio in Malta, all of the rental income pools, investments in the stock exchange, all of those. We're not for one moment saying that they don't contribute to the retirement space, but they contribute after we've secured. So our business is about risk management and making sure that we get to an outcome, not thinking we're going to get to an outcome. Okay, and if we plan in business, we're thinking we're going to get there. So not right. Okay, go. There we go. Yeah. Just in terms of the effects of inflation over time, 1970, you could buy a brand new vehicle for 1,000 rand. 1980, you could buy a motorbike. 1990, you could buy a bicycle. 2010, you could buy maybe a relatively decent set of running shoes. And 2020, you can't even buy socks for 1,000. So the effects of inflation, guys, is ginormous. I'll show you numbers wise. And this is not some fancy calculator. And I urge you all to do this. It's an exercise that really sense to life. You've all got access to Excel. Go and put a line, put a number, and compound it by 7% per annum. And see how quickly that number grows. So when we start talking about how we need to invest and how much we need to invest, you think you're mad. That's too much money that I'm putting away. But understand in 20 years' time, how much you're going to be drawing in order to get to that kind of number. That's right. 35-year-old needs 20 grand today at 65. And again, this is where I say, this is an Excel working. This is not a fancy number crunch. Okay. Present value 20 grand he's wanting. At age 65, he's going to need to actually withdraw 152,000 rand a month, okay, in order to buy the same stuff that 20 grand does today. Not lost. Okay, at 79, during his retirement period, he's going to be drawing nearly 400 rand a month in order to buy what 20 grand buys. And at the last, at 85, when he needs it the most, he's going to be drawing nearly 600 rand. So these are, again, these are not opinions. These are mathematical equations. This is what it is. It's not my opinion or me trying to sell you down a path. Another little thing is the cost of delay. Is to say, when did you start saving for retirement? When do people stop thinking about it? Answer that question. So in my experience, normally at around age 45, my family in the headlights come up, oh, my goodness, what's going on now? I'm going to be retiring in 20 years. Better do something about it, let me take out $100 grand. Okay. Now think about this logically. If we start saving at 45 and we want to retire at 65, how much time do you want to actually stop in retirement? How long do you want to plan for? Should it all? 65 to 90 to 85? Okay, most people say 20 years. Right, now put that back into context. I've got 20 years to save for 20 years. So what does logic say? Say 50% of your current earnings if you've only got 20 years left. People say math, so it's not math. Surely the logic of what I've just spoken to you makes sense. It's not, again, a theory. It makes absolute sense. And the problem is that people think that putting a couple of $100 grand away is going to solve problems. I thought, before I joined the industry, I had a slick talking note from someone comes sold me a product. He sold me a couple of $100 grand product, and he showed me a telephone number that I was going to retire. I honestly believed in my heart was that I was sorted for life. Okay, I never saw him again, and I never ever saw him have money. But still, that's the kind of mentality that we have in the days gone by. But we are not magicians. The secret to our business and the secret to any investment strategy is something called compound growth. And compound growth can only occur with money over time. Compound growth is not something that is instant, and it's not something that we can wish into being. It's something that has to be paid for. So if we've got, getting ahead of myself. If we contribute 1,200 rand from age 20 to age 30 with an escalation of 6% per annum. So all I do is save for 10 years, from 20 to 30, okay? 1,200 rand. My net result at the end of time would be 500,000. If I didn't save between 20 and 30, and I started saving from 30 to 55, okay, I would have to invest 2,150 for 25 years. Okay, this I only did it for 10. I would have to do it for 25 years to arrive at roughly the same result. So guys, the cost of delay is dramatic. A little bit of a rule of thumb that we use is that in order to retire on 100% replacement ratio, you're talking about having to save 15% of your gross income. Okay? Gross income, not net income. 15% for a period of 30 months. How many are doing that currently? How many people ever will be able to do that? Okay, because when you're 20, retirement annuity is the last thing on your mind, saving is the last thing on your mind. So understand that in this country, the average time a person spends on a fund before they retire, and I'm not talking about the masses, I'm talking about A and B income cost, is 16 years, just below 16 years, that they spend on retirement. And here's the curveball, is the 15% that they've got on their fund is not of their gross capital, because they try to whittle it down as far as possible, because they want to save more premium. So he's saving 15% of a reduced income. If you're a commission earner, it's normally just the basic salary. If you're on the fund, they give you the ability to flex up and down. So everybody will go for the savings. So you're saving 15% of a falsely deflated salary for 16 years and hoping that it gives you what you're earning currently for 20. It cannot. It absolutely cannot.
This is Steve.
Hi.
Steve doesn't know it, but he is South Africa's worst market timer. In 1970, he started working at the age of 20 and did all he could to save his money. 1,900 Rand. It took him 4 years to finally build up the courage to invest this money in the market, specifically the JSE All Share Index. Little did he know, he was doing it at the peak of the market, right before a crash, which saw him lose 40% of his investment. The same thing happened to him 4 more times. In 1980, he put in 5,000 Rand and lost 38% in short order. 1987 saw him lose 40% of his 12,000 Rand investment to Black Monday. In 1998, he invested 62,000 Rand as the tech bubble popped. And in 2007, he lost another 40% to the global crisis as he tried to take one last stab at the markets before retirement. But this is where Steve was smart. He never sold out to the market once. Not once. So, how did he do? Well, even though he bought in at the worst possible time, Steve still ended up as a millionaire with 4.2 million Rand, beating South African inflation over this period by over 4% per annum. So, what did he do right? 2 simple things. He was a committed saver and increased the amount he saved over time. And he allowed his investments to compound through the decades by never selling out. The moral of the story: stay invested. Obviously, you should do so with a tailored investment portfolio that meets your specific goals and needs. We do just that. We manage a range of investment portfolios that cater for a broad spectrum of financial needs. All you'll need to do is take a cue from Steve and stay invested.
So like we always say, guys, it's time in the market, it's not time. If you're going to start timing the market, you're going to shoot yourself in the foot. You'll never find the right time to sell, you'll never find the right time to buy. So it sounds like a broken record, but the only time that you take a loss in the stock market is if you sell when there's a crash. If you stay through the rough times, you will always outstrip inflation significantly. It's only asset class that done that over any given time. So I need to pick it up a little bit. Just in terms of speaking to that, it's just a photo of Elliot and Hussein, just to underline the fact that some investments are sprint races, some investments are marathons. Okay. Do not look at marathon money by comparing it to sprint money. And do not ever go to sprint money with money that you might need short term, because sprint money is dangerous. We liken it to Usain Bolt breaking a shoelace. That will bugger up his race. It won't let him finish the race. But if a marathon runner loses a shoelace, he's got time to live on no one. You borrow one from the spectator, he can stop, he can tie his shoelace. So the hiccups in the marathon can be overcome. The hiccups in a 100-meter sprint can't be. The importance of getting it right in terms of risk profiling as well is imperative, because I said the secret is compound interest. And if we change compound interest rates, the change to the outcome when you start stretching at 20, 30 years is significant. Every percent difference in return changes your outcome vastly. And in this graph, we show it, okay? 1,500 for 35 years at 6% in a conservative portfolio. The result, 3,600 per month. Exactly the same, but in a cautious investment at 10% would result in a monthly income of 6,400. So where would you rather be? Obviously, you've invested exactly the same money, but just because of the difference in compound interest, that is what happened. In a moderate portfolio at 12% and at a moderately aggressive portfolio. So depending on where you put your cash, exactly the same cash over 35 years could give you 3,600 a month, or it could give you 1,400 per month, depending on your risk profile. So it's imperative that you take as much risk as you possibly can, as much as you can tolerate for best results. And if we're talking about retirement money being 35 years out, even if you're conservative by nature, my advice, you would not be putting conservative portfolios, because the outcome is going to be such significantly different. So again, we're not advocating that you take unnecessary risk. We're advocating that you take as much risk as you can tolerate, because that will give you the best possible outcome. Just another little thing before I hand over to Mark, I know that I'm running out of time, is one thing that we do very, very effectively within the group and with our clients' funds. Everyone says who's got an investment manager, I'm running your money. 9 times out of 10, the guy's not running your money, he's reporting on it. Because he selects a couple of unit trusts, okay? He has got no influence on that unit trust. And he comes to you every year and he says, listen, either we had a fantastic year, if you had a bad year, you don't see it. It doesn't come to see you thereafter. So the game is, he's not running your money. So why are you paying him asset-based fees if he's not actually involved in the money? What we do is stick to decisive discipline in running money. And just to emphasize that, let's say we saw you last year, you came out as a moderate, so we've got you 50% equity, 10%, 20%, 20% in terms of a diversity. Of the $1 million you've given me, that's where I put it. All of a sudden, we have a bin, like we did last year in American tech stocks. They just went ballistic. Okay. Now we have, again, 50% in our equity exposure. What happens to our overall exposure? We jump from where we were now, moderate, we are now extremely at risk, because we've got 75% of our plot of $1 million, okay, which has now grown to 1.5 million, exposed to the equity market. So what would logic say? We've got to rebalance this portfolio. Because when you give me what is called a mandate to run your money, it's an instruction, Brett, you will keep my money moderate. Okay, I've got to comply with that. If I come to you after this run and you're not in an in-house fund, and I say to you, listen, guys, we've had such a fantastic run. Let's sell all of those stocks that have done well and buy all the dogs that have done quick. What's your response to me? Brett, you touched my money, oh, I know. Okay, you're not going to sell my winners. I've just made huge money. Why do you want to sell them? But in addition to that, sir, you're going to get a capital gains tax. Okay, are we going to get the discipline right? So no, we're going to leave the portfolio as it is. And then what happens when you take the 50% track? We come back all the way down to cautious out of one. So you're playing the whole scale all the time, you don't even know that. It's just happening in the background. Whereas with people running money properly, they're keeping you within mandate all the time. So if we had a bullet like that run, we would have sold out and then gone back to 50% and redone the spread. And it's called rebalancing a portfolio, part of an essential discipline in running money.
Have you ever?
I don't think we need that. I don't think we need that. It's numbers. And then in closing, guys, a slide that makes me talk to the bone every time I look at it. Bearing in mind that you only save once a month for a time. Okay. So you've got 12 deposits in your piggy bank to make every year. So depending on how old you are, if you're 30 years old currently, you've got 420 deposits to make before you retire. If you're 35, you've got 360. If you're 300, if you're 40, you've got 300. If you're 300, I hope you have a hell of a lot of money when you retire. So 50, 180. So guys, I urge you to get saving as fast as possible, because I'm actually can go into the domain now, 55 plus. So it's scary how quickly time goes by. And if we don't start saving quickly and saving well, you youngsters in the room, you've got the perfect opportunity to get yourself going fast and getting ahead of the curve and making it part of your business practice and part of your personal life practice to install that in you from day one. It'll be the best decision you make. Thank you very much. Mark, over to you.
Morning, everyone. Thanks for that, Brent. I think one of the, we're going through very much the one in that presentation. Certainly is one of the issues that people don't address early enough in their life, where you should start investing for your retirement when you first enter the first door of your first job. And it's vital to do that. And I take a lot of joy out of speaking to my clients' kids when they say to me, what do I do? Where should I start investing? I say, I don't really mind where you invest, just invest. And make sure that that money is put aside, as Greg was saying, don't mess with that money. That money is your future, that's your kids' future, that's your retirement money at the end of the day. And it's vitally important that you have a discipline to continue with that regardless of what's happening. And it's so difficult, it's very difficult. Things happen in life and you want to draw on that money. But if you want to have a retirement, then you've got to have the discipline to continue with the plan that you lay out for yourselves. So, my side of the presentation is a little bit more of the how and a little bit more detail regarding our funds that we've just discussed there. And I had a look at this intersection. This is an intersection that was actually built in China. I think it's in the Quattro province or something like that. There's 23 or 24 different highways converging into one place. And would you want to get onto that highway? Absolutely not. And that is really what investing can be like for individuals. It's extremely complex. It's extremely daunting. People don't really know what to do. I often hear people say, what are my returns going to be? How's the market doing? All these questions. But in reality, what they're saying is, please, can you reassure me that my money's safe? And that is fundamentally what we're here to do. Now, when you are saving when you're saving for retirement, you've got two different options. More than two, but two main options. One is retirement savings, and that's the RAs, the pension funds, the provident funds, your employee benefit scheme, preservation funds, all those nice things. And those are the ones that you need to have on a long-term basis if you start early on in your career. You've also got voluntary investments, and those are the ones where you say, okay, well, I want to open a share portfolio. I'd like to buy some unit trust with Ellen Gray. I'd like to have some coronation, whoever it might be. So you've got different ways to invest in order to grow your wealth. And within each of those different types, I don't know if the pointers are.
Top one. Top.
Okay. So here you've got your voluntary, you've got your endowments, your direct investments, private equity, property, anything like that. So those are your after-tax money that you're investing. This side here is your retirement savings. It's really pre-tax money that you're investing. And the government gives you a break, and then they don't tax the money while it's in that structure. So you can compound your earnings a lot better within those structures. The investment choices are much the same. You have trust portfolios, government bonds, corporate bonds, junk bonds, private equity, you can buy art, you can buy Bitcoin, you can buy gold. The world is your oyster. And that ultimately is the problem, that there's too much choice out there. And you can't get involved with everything. You can't make a decision based on your future on what someone tells you on the golf course or what your shoe shine guy tells you. I know Sir John Templeton from Franklin Templeton, one of his famous sayings was that when his shoe shine guy started to tell him what stocks to buy, he knew it was time to sell out of the market, because that is exactly what happens. And I've seen it here locally. I've seen it with Bitcoin in particular, where, you know, going up an escalator and I listen to a conversation in front of me, and the one guy saying, oh, you know, young guys, if you trade on this platform and you get these fees back, and I just bought this Bitcoin and that, and there's no real strategy there. There's no long-term planning. It's better. You might as well flip Bitcoin. You might as well go down to the casino, because that's basically what you're going to achieve. Our job at the end of the day is to smooth the road out for you and to help you with your investment choices. And the Quattro funds are unit trusts, and that's how we achieve long-term growth for our clients. So what we want to do is get you on a path and get you to stay on that path, get you into a less complex and less complicated situation so that you can understand your future. Now, how do you choose your funds? I don't know if anyone knows this, but there's over 1,200 registered unit trusts in South Africa. Believe it or not, there's only 422 listed shares on the stock exchange. So there are today more unit trusts than there are shares on the stock exchange. And let's face reality, all those unit trusts basically are investing in the same market. So they're all buying the same shares, maybe a little bit different, maybe a slightly different strategy or a slightly different theme to the fund. But effectively, they're all playing in one market, which is a little bit limiting. You do need some offshore exposure. There's 34 unit trust sectors. So not only do you have 1,200 unit trusts, but you have all these different sectors. You have bond, you have income, you have money market, you have high equity, you have medium equity, you have low equity, you have multi-asset, you have multi-asset, high equity, it's just unbelievable. So the reason why I put this up here, and again, it goes back to the complexity of investing. You know, it's not easy choosing the right funds at the end of the day. And I suppose your choices are that you can either go it alone or you can team up with an expert advisor. And I like this picture because this chap here, we all know who that is, the Lone Ranger. But in reality, he wasn't the Lone Ranger. He had a sidekick, Tonto. And Tonto was always there guiding him and helping him. And it always reminds me of a great joke with the Lone Ranger and Tonto riding through the valley. And suddenly the Lone Ranger looks up and surrounding them are Red Indians, and they're coming down to attack them. And so the Lone Ranger turns to Tonto and says, yeah, I think we're really in trouble this time. What do you think we should do? And Tonto turns to him and says, who's we, partners? But the bottom line is make sure that the partners that you choose are there for you and are going to be there for the long term as well. Now, so how do we do it? Okay, Quattro Fund Managers is a Category 2 licensed fund management company, and we run 4 unit trusts in South Africa registered here. We have independent portfolio advisors from Analytics, and Analytics does what I like to term all the heavy lifting. They do all the real calculations, they look at all the funds, they visit the fund managers, they do all the assessment. And by funds, I mean other unit trusts. So we're looking at other asset managers. We're looking at the Allen Greys, the 91s, the Coronations, the Fords, the 360s, whoever it is that are good asset managers we want to have. And what we do is we put their funds into our funds. So we can get to choose the best of the best. And Brent was alluding to it earlier, but one of the main benefits of a fund like this is that if you're in that situation where you've got your asset allocation, which is what we do, we will allocate equities, bonds, cash, whatever it might be. And then we need to move money out of one fund in the equity, and we've gone up to 75% of the portfolios on equities. We need to clear it down to 50%. When we sell that fund, there's no capital gains within the portfolio. So for our investors, it works out a lot better. Because if they were independently in each of those funds, when they sell the fund that made money, then there will be a capital gains event. Fundamentally, when you sell our funds, then obviously there would be a capital gains event. But while you're trading within that, the capital gains is looked after within the unit trust. We have independent administrators. We don't administer the money. With money doesn't come to us, it goes to the administrators. All our funds are risk profile, going back again to what Brett said. You've got to be in the right fund at the right time in terms of your risk profile. But one of the biggest things is, and there's a lot of talk where people are nearing retirement and they always want to reduce their risk level. And I think there's maybe a little bit of confusion about what risk is. You know, what is risk? Is risk the loss of all my money? Is it the volatility? Is it, how much do I stand to lose? Risk and timing are sort of two sides of the same coin. If you've got enough time, you can take a huge amount of risk. If you have a very limited amount of time, you can only take a small amount of risk. Because as you get closer to retirement, it's very important to keep your capital intact at that point. So you don't want to be in a situation where you're retiring in April 2020 and all your money's in the stock market. What happened? March 2020 came along, the stock market crashed by 40%. Your retirement funding was down by 40%, and you needed to take it out at that point because that's when you were retiring. So you've just got to be careful as to where you are and at what life stage and at what point in your life you are. They are actively managed. We don't just leave them and let them sit. And 3 of the funds are Section 28 compliant. So what that means is that you're able to use them in your retirement funding investments like your RAs, your First Nation funds, your employee benefit funds, that type of thing, because they're governed by the Insurance Act in terms of how much you can invest in certain asset classes. Okay, so what are the benefits? The benefits are you have the expertise of not only our team, but the team from analytics as well. So you're not just going there, having a look at the newspaper, reading it and says, oh, well, this fund did really well last year. They won the Bull Award for unit trust in the equity sector. I'm going to put my money in there. I'm not saying that that fund won't do well this year. However, you do need to do a bit more research on that. And if you want to go to loans, you're going to be doing a hell of a lot of research on 1,200 funds. You get diversification. You get the funds are all risk profiles so that they can suit your risk profile. There is flexibility and tax benefits I've discussed already. So what's our investment philosophy? Number one, diversification. Okay, we are always looking to diversify the risk of the portfolio, and that we can do either through the asset class, that would be equities, bonds, cash, or through the management itself. So if we choose a manager like an Allen Gray or a 91, they manage in a very specific style. Their main funds, as an example, if you look at the Allen Gray Equity Fund, the managers there, it's made up of little baskets, that fund. And each basket is managed by a different manager. So you're getting quite a big blend of different managers within one fund. The 91 Equity Fund is run very differently, where they have one fund manager making the decisions. So you've got to look at the different nuances with the funds to try and select the right one that's going to fit into your strategy. And that's what we do. We do the work behind that to make sure that we've got the right funds at the right time. Also, I mean, if a fund's got to focus on very big companies, blue chip companies, and we feel that's not the right space to be in at the moment because maybe inflation is dropping or interest rates are dropping, so smaller companies will benefit from that. We would rather be investing with guys who are investing in the smaller companies. So we look at all of that when making the investment decisions for the funds. We look at active and passive returns. And basically what the difference is active is choosing investments that will outperform the market. And passive is just going with the market. So if you must have heard of ETFs, that type of thing, which are basically exchange traded funds which are linked to the market. So if I go out and buy the JSE, then I'm buying every single share in the JSE. And my performance will be exactly what the JSE is doing. But what I'm trying to achieve is I'm trying to outperform the JSE. I want to just get what the JSE does. So the outperformance is the alpha, the active. So I'm looking for managers who will outperform the market rather than just being the market. Otherwise, I'm just going to buy an ETF, and that's cheap. We optimize the portfolios based on return objective, downside risk, and cost. Cost is huge. Cost is one of the biggest issues facing our industry at the moment. Because, and Brett alluded to as well, when you look at the percentages, how they impact the growth over a long period of time, it's actually massive. A 1% difference in fees or a 1% difference in costs can have a huge impact on your investment over 20 years. And I mean, I don't have the graphs here, but I've done the graphs and I was quite shocked by it as well. So if you look at that, you've got to always contain the costs, and we do that on an active basis. We're always looking where to contain costs, and that's for our clients at the end of the day. You know, they're going to get the benefit from it, not us. So how do we do it? Well, firstly, we have a fund mandate, and the fund mandate is going to determine what we can invest in. So, for example, if we have a cautious fund, or a growth fund, or a moderate fund, we have a different mandate for each fund, and we've got our worldwide fund as well. So, when you look at the mandate will say it's going to be managed in a cautious manner. You're not allowed to have more than X amount of funds or X amount of equities or anything like that. So that's our sort of our framework that we utilize to manage the money. We then go through a screening assessment of all the funds that are available. That's okay, and that's what analytics does. They take all the funds, 1,200 unit trusts, we screen them all, say which ones are of a certain size that we need them to be at, how liquid are they, all those type of things, and then we will make a decision based on that. We'll look at qualitative due diligence as well. So that is a meeting with the fund managers to understand them, to understand what they do, why they do it, and how they do it, and obviously to assess them. So it's basically a due diligence on each fund manager that we utilize. We will then do a fund selection from these two, and then we'll also look at outliers. And outliers, what we term as outliers, are really those funds that don't really fit within our specific mandate. So maybe if we have a mandate for each fund, the fund has to have a minimum balance of 5 billion rand, as an example. If the fund is maybe 3 billion, but we feel that it's a really good fund, it's a new fund, it's been managed really well, we will look to include it. But obviously we won't include it to the level that we would in a big fund that puts it in our mandate. And then there's permanently ongoing monitoring. We meet on a monthly basis, and there's permanent communication between ourselves and analytics as to what's going on with the fund. If there are any issues in the market, we also look at it as well. Now, going back to that, I think that what's important to understand is that when we manage the money, it's not done on a knee-jerk reaction. And that's often what people do with their investments. They look at the market, something happens to the market, they phone me up and they say, what do I do when markets are crashing, or this is what's happening, is there going to be a war in Ukraine, or how's that going to affect my portfolio? And 9 times out of 10, my answer is going to be just all times. We are well planned, we're well structured, things will move along the road. If there's a hiccup along the road, then we'll assess it at the time and we'll make the right decision. Because everybody is emotionally tied to their money, and everybody is worried about their money. And it's our job at the end of the day to manage the money correctly in a way that helps them to sleep at night. And that we do through all these processes. Now, the 4 funds that we have the cautious, moderate growth, and the worldwide fund. They're all multi-asset funds. The Quattro cautious fund, the cautious fund is a low equity portfolio. So that's going to be your least risky one. And its focus is on capital preservation. So as an example, if you're nearing retirement, this is where we would put you, okay? Because we don't want to have capital volatility as you get closer to retirement, as I said earlier. The moderate fund, slightly more aggressive. It's got a medium equity exposure in that, so it's going to have a slightly more aggressive profile. The growth fund is really, this is probably one of our best. Well, I think it's probably our best fund because it's the one that I see as the one that's going to give you the most capital growth going towards retirement. And often what we do is we mix the funds up. So if you come to me and I can see that you are, in your mind, you're a cautious investor, but where you should be is growth, what we're going to do is we're going to mix those funds up slightly so that you can have the peace of mind, but we can try and get you the capital growth at the same time. Our flexible fund is our worldwide fund, and that's invested purely offshore. Now, the reason there being is that, I mean, as a percentage of the global economy size, it's minute. It's something like 2% or 3% of the global economy. So we need, as investors, to have exposure internationally. We do get some of it locally through some local companies with international exposure, but fundamentally, we can get better returns offshore. So what we do is we establish this fund. That fund invests solely in funds that are offshore. The other way to take your money offshore is to go through the normal allowances, but this allows you to go into an offshore investment on a monthly basis by a debit order or through a lump sum quite easily. You can get access to your money as well. Okay, so now just going to where this all leaves us. I've given you the details about how we run these funds, what their profile are, all that kind of thing. But I don't know if you where does this leave us? Because after all, we one of those 1,200 funds that are now listed as a unit trust. So this graph here shows you two things. It shows you on this axis here is your 3-year return. So that's an aggregated annualized return. This here is your standard deviation. Now, our standard deviation, that's our traditional measure of volatility for the portfolio or for a fund or for anything. So it's how volatile it is, how much it goes up and down. And what you see is bond funds will have a small amount of volatility, equity funds will have a bigger amount of volatility, and a small cap equity fund will have a massive amount of volatility. So what you don't want to be is you don't want to be in a situation where your volatility is off the charts over here and you've got very, very low returns. So you don't want to be down here. That's your kind of your worst case scenario. Your best case scenario would be up here where you've got a massive amount of return at literally zero volatility. So what we try and do now, each dot, I know it's difficult to see, but each dot signifies the funds that we invest in our funds, okay? And that's all these little green dots. The bigger blue ones are our core funds. So what you can see here, there's our Quattro cautious. So it's got a volatility of around 5.2 and its return is about 9%. The moderate, so a slightly higher return, but also slightly higher volatility. The growth has got even a higher return with a higher volatility. And the worldwide flexible has got a similar type of growth at a slightly higher volatility. And the slightly higher volatility is really a result of the rand, because obviously we all know that the rand is extremely volatile, and that adds to the volatility of that fund. So what we've done is we've taken all these other funds, and these are all the funds that are represented in CAP. We've mixed them up, and we've created a situation where we've got our performance in a zone where, number one, we're beating the money market. That's really the money market right there. Okay? And number two, we've got our risk and our standard deviation less than the JSE All Share. So our investments are performing better than cash and lower volatility than the stock exchange. And that's really what we're trying to achieve. And we need to achieve that consistently. And we need to achieve it year on year on year on year. This is not about beating the market every single year. This is not about outperforming all the other funds every single year. In my world, consistency wins. And it's the tortoise in the head. I'd rather be the tortoise, I'd rather be the guy who's just plodding along, gets the performances and keeps on going. It's not flashy, it's not it's not in your face, but it certainly gets you the results that you need at the end of the day, and that's what we're trying to achieve. Yeah. Yeah. This one. Yeah. It's the overall portfolio. Yeah, that's the overall portfolio's standard deviation. So in that situation there, we've got a mix of underlying unit trusts that are registered offshore. So in that situation, let's say the offshore market's done 7%, but the currency has done, has depreciated by 7%. Your overall returns will be 14%. But with our currency, it moves up and down quite a lot. So it creates a bit more volatility for that portfolio. So what I actually like to do is look at that portfolio in dollar terms. And what you'll find in dollar terms is that its standard deviation is a lot lower than in rand terms. So the actual investment has a lower risk. But for South African in rands, it seems higher. So that's over 1 year. This is over 2 years. So what you can see is we're still within the same block here. So there's your money market or your cash rate, and there's your JSE risk. So at this point in time here, we've got the worldwide fund is a much higher return, but here are other funds as well. So we're still sitting in the same block that we want to be sitting in. And the reason is that if we started to drift out, and we were over here somewhere, we would be drifting outside our mandate, and we wouldn't be fulfilling what we're supposed to fulfill for our investors. So at the end of the day, we're working for our investors, and we're working for consistency, and we're trying to manage the risk of the portfolio. And we're doing that through analytics, through all the different funds that we utilize, through all the research that we do. We've taken another step further. This is basically the same graph again over 1 year. So you've got our 4 funds here, which I've taken out all the rest of them. And there's the JSE All Share. And what I put in here is I put in for last year the top performing unit trust in South Africa, and just a couple of other ones that I thought were appropriate. I'm not going to name them, but they are well-known funds. And I want to show you between this fund here, you have that over 1 year, and then over 3 years, if you have a look here, this fund here and this fund here, they've swapped positions. If you can see how that has changed. And the reason being is that they're obviously slightly more volatile. And if you have a look at our portfolios have maintained within that same block rather than shifting around and flying around. So the point of this graph is more to say you need the diversification in your portfolio. You can't put all your money on one horse. It's like going to the races and saying, I'm going to bet on the July, I'm only going to bet on one race, I'm going to bet on one horse. I'm going to put all my money on that. Doesn't make sense. Yeah, well, I'm going to the roulette table, I'm going to put everything on black, and either I'm going to win double, and I'm going to walk away. That's fantastic. But if the likelihood of winning is 50-50, and we don't like those odds. We want odds where our clients are going to win at the end of the day, and our clients are going to grow their money at the end of the day. And I always love to put this one at the end. I'm sure you all know Bitcoin. You have a look at exactly the same graph. Now, this is where we're all sitting down here. That's those previous graphs over 1 year. That's where Bitcoin sits there. Now, a lot of people talk about Bitcoin. It's the sort of the topic at the moment. It's crypto and NFTs and all these fancy things. One thing is I don't understand them. I've tried. I understand that the prices go up and down, and it's hugely volatile. And I understand that lots of people want to be invested in it. But to me, it is another asset class. And at some point in time, we will be including it as another asset class in our portfolios. But the crux of the matter is how much do you put in there? I mean, I hear stories of guys saying, well, I've sold all my unit trusts and bought Bitcoin. Well, okay, nothing to sleep at night, but, you know, maybe that's good, maybe that's bad. And personally, I think out of every story you hear of somebody making money in Bitcoin, there's probably 1,000 people who've lost money at Bitcoin. Nobody buys at the right time, and certainly nobody sells at the right time. Now, buying is easy, selling is very difficult. It's the same in the share market, it's the same in any other asset. It's very easy to buy something, but selling it is difficult because you don't know where to sell. Because you get fear of missing out on the growth, or you panic and you want to sell early because the markets have crashed. So I like to put that up there just to put it into perspective. I'm not saying that Bitcoin should not be part of your portfolio, but it needs to be tempered, and maybe 1 or 2% of your portfolio should go into something like that, specifically if you're planning for your retirement. Because if you're going to retire and you're relying on Bitcoin, I think you're going to have a rough retirement. Either you're going to be on a yacht in Greece, or you're going to be cleaning the yacht in Greece. One of those two things that's going to happen. So yeah, you know, I think that just puts it into perspective to give you an idea as to what we do from a fund perspective, how we do it, and why we do it. And the why, I think, is the most important. The why is to make sure that our clients grow their money and it goes towards their retirement. People can retire in a fashion that they would like to retire. Because I see people all day, every day that don't have the funds for retirement. And it's hard. I mean, I saw people this week, and the person's retiring in 3 years' time, and their pension fund was 525,000 rand. And I said, is that all you've got? You know, is that the only thing that you've got? Yeah, that's the only thing I've got. You own your house now, it's for rental. Somebody's worked for 17, 18 years for a company, and that's all that they've got. So they said, you know, what's your advice? I said, my advice is cut your costs and stick anything that you have excess into investments for the next 3 years, up until 3 years from retirement. Do whatever it takes now to ensure that you can retire at least slightly better in 3 years' time. But even then, I mean, you run the spreadsheet and it just looks terrible. There's only, I was only 17,000, 18,000 rand a month, and he's going to be taking home maybe 1,500 rand on this retirement fund. So that impact is massive. And one of the best things that I like in dealing with my clients is that often I get to meet with their kids. And the first thing I say to their kids is, where are you investing? Start investing now. Because if you start investing now, you can put away, and the calculation will show to you, you can go out and do it any month. Listen, I don't care where you put it, just put it away and put it somewhere where you can't touch it. Because the biggest thing is that people dip into their retirement and think, oh, I need the money now, or I want the latest car, or I want to go on an overseas holiday, and they're going to take the money out of retirement. What they don't realize is that spending that 100 rand today is taking 500,000 out of their mouth in 30 years' time. And that's the reality of it. So, yeah, if there are any questions on the funds? Thank you very much. Any questions, let me know. Yeah.
Thank you. There was one question. I say that was 100. So the minimum we have to so, moving 5 years
Everyone is different.
Yeah.
Yeah. Yeah. Honestly, I'm very confident in our funds. Okay, and I'm very confident that they are geared towards capital preservation, all of them. The worldwide fund is slightly different because of the currency implication, can be a little bit more volatile. But 5 years before retirement, I'm happy for someone to be in moderate, and I'm happy for someone to be in growth as well. And I'm cautious, I advocate to people who need an income off the money that they've got. So if you are retiring and we now starting to structure your income, then we look at the cautious, because then you have certainty going forward. But in order to maximize your retirement, if you say to me on this specific day, because most people can't do this, what day are you going to retire? What day? No one knows what day they're going to retire. It's going to be around about when I'm plus minus this old. So if you said to me, this is the day that I'm going to retire, then we can plan quite specifically. But most people, 5, 10 years before retirement, I'm happy, take all the risk you can. Take all the risk you can and don't look at it every day. That's my other thing. Do not look at your investments daily. Look at them once a year or once every 2 years. They say the best investors, the guys that perform the best, are dead people. Okay? You hear all these foundations, and this foundation's worth billions of dollars. Why? Because the guy died, he left all the money to a committee, and the committee runs the money, and they've got no emotional involvement. So if you don't have that emotional involvement to your money, not saying you won't be attached to your money, but if you don't have that degree of emotional panic or euphoria when the market's up and why am I not up 80% or why am I down? If you remove yourself from that and you let the money run for the long run, then it will cry. Yeah, but in answer to your question, how do you select which fund to go into, which point in your life? Each person is different. Each person has an internal risk tolerance that you've got to take into account. And some people just will not stand for their capital going down at all, in which case they have to accept the fact that they're going to go into a cautious fund and it won't grow as much. And people do accept that. Other people say, take my money, do what you want with it, I'll support you in a year's time. My favorite times.
I think, Len, also to answer your question in a different way, everybody sees retirement as a happening event. Like I'm going to gear down to retirement. Okay, then we gear down and we put everything cautious and do all of that. What do we do when we retire? We go and we have a look at the market and say, where should we put our money in? So the philosophy is, whatever you've got your money exposed to must be a philosophy for life. It might come out of your retirement fund and go into a living annuity, but the living annuity will be exactly the same mandate as what it was when it was in a retirement fund. So whether it's good time, bad time, or indifferent time, you're still going to, maybe you have a market crash when you retire. So what? You take the money, you go buy exactly what you had, okay? And when it recovers, you recover in your living annuity. So this whole event planning is not really an idea. I like to dumb it down and say, listen, you've got this big pot of money. What it's called, where it comes from, what it becomes, doesn't matter. It's a pot of money that needs to be appropriately managed for the duration of your life.
Is it not?
Yeah, I advocate a lot of short. And it's not just because of the land, it's because of the fact that we are a smaller part of the world economy and we are an emerging market. So there's a lot more volatility, there's a lot more risk attached to us. So I would maximize it short if you can. And I would maximize by taking advantage of the 1 million rand allowance, first and foremost, to get the money out of the not short. But when you do that, just be careful because there's a lot of implications in terms of the structure that you go into on the other side, in terms of estate planning, taxation, all that type of thing. So it's a bit of a minefield, but there's a lot of ways to do it that work out properly. And it can be a lot more tax friendly than having it to South Africa, which I advocate as much as possible. Yes.
There is another one that you spoke about. Citizen. It's not one specific state should be worthwhile. And it's been spent, it's income. So you said that after 2 years of it's already moving up. You take the losses and take them out of the line, invest it in something,
I think the first question is what's the money? What's the reason for the money? Is that your retirement? Is that your investing money? Is that your, I mean, I got money that's first. But as I said earlier, it's easy to buy. It's very difficult to sell. Because you're in that situation of, do I sell, take a loss? Do I sell and miss out on maybe it will skyrocket again? It's very difficult. If you want to, if it's just kind of a blank thing, I dealt with the guy, a really good example. I dealt with the guy who worked for multi-choice, and he went to America, this is years, like 15 years ago, and he was a cameraman. And he went with DSTV or multi-choice to America, and they started a company there with these television top boxes, I don't know what they did. And it was called like a lot of Sun Systems or something. And when he started, he was one of like 5 employees, and I gave him shares in the business. And within 2 to 3 years, his shares were worth $100 million. Okay. I think he had the share price was $100, and he had 1 million shares. And he came to see me while I was working at another company. And I said to him, so what have you got? No, I've got these shares. That's what I've got. I said, what else have you got? No, nothing else. I said, but why have you only got 1 share? It's not that. I mean, I started with 0 3 years ago. I'm now worth $100 million. I said, okay, awesome. What we're going to do is we're going to sell those shares, or a large portion. I said, no, I want to be in the tech sector. So, we're in the tech sector. We'll just diversify you more. Yeah, maybe, I'm not sure. I think this is going to go higher. Long story short, he kept the shares, and then went down to like 2 cents a share. So he ended up with the property. He had his house that he'd sold, that he had bought, but that was it. And it goes to that risk issue, and it goes to your emotional attachment to things, and you've got to distance yourself from that. And that's why you need an advisor. The advisor can come and say, you're talking nonsense. Don't do that. You've got to do it this way. This will work. And if your advisor can show you that, then there's no reason not to do it. So yeah, in answer to this, sell the shares.
Well, thanks very much, everybody. Have a good weekend. Thanks for joining us today.